Welcome to the Classified Balance Sheet presented by Dr. Jessica Woolworth, Certified Public Accountant. You already know that the balance sheet reports a company's assets, liabilities, and stockholders' equity. It shows these accounts at a specific point in time. But companies usually don't just list all of their assets together and all of their liabilities together. Instead, they organize them into categories. That version is called a classified balance sheet. In this video, we'll look at the major classifications and what belongs in each one. We will also explore why these classifications make the balance sheet much more useful. Imagine that you are trying to evaluate a company. It tells you that it has $1 million in assets. That sounds useful. But what kind of assets? Does the company have $1 million sitting in cash? Does it have inventory that it expects to sell next month? Or does it own a building that it plans to use for the next 20 years? Those assets are very different. Classification helps users understand a company's liquidity, financial structure, and long-term resources. Current assets are assets that a company expects to convert to cash, sell, or use up. This happens within 1 year or the company's operating cycle, whichever is longer. Common current assets include cash, short-term investments, and accounts receivable. Other examples are inventory, supplies, and prepaid expenses. These are connected to short-term operations. Cash is already available. Accounts receivable should be collected from customers. Current assets are listed in order of liquidity, meaning how quickly they become cash. That is why cash appears first, after current assets. A company may report long-term investments. These are not for immediate use. Examples include long-term investments in stocks or bonds, or land held for future use. The important distinction is the company's purpose and expected holding period for that investment. Next is property, plant, and equipment, or PP&E. These are tangible, long-lived assets. They are used in the operation of the business, such as land, buildings, and equipment. These assets are not purchased for resale. They are purchased because the company needs them to operate. Most property, plant, and equipment is subject to depreciation, reporting cost along with accumulated depreciation. Land is an important exception. Land is generally not depreciated in the accounting records. This is because land is considered to have an indefinite life. Intangible assets are long-term assets that do not have physical substance, such as patents and copyrights. A patent can provide significant economic value even though you cannot physically touch it. That is why intangible assets are reported separately from tangible assets like buildings and equipment. Now let's move to the other side, liabilities. Just like assets, liabilities are divided based on timing and duration. Current liabilities are obligations that the company expects to pay within 1 year or its operating cycle, whichever is longer. Common examples include accounts payable, salaries and wages payable, interest and taxes payable, unearned revenue, and short-term notes payable. Think about accounts payable. Money owed to a supplier that will normally be paid relatively soon. One item that causes confusion is the current portion of long-term debt. Suppose a company has a 10-year loan. The amount due within the next year is reported as a current liability. The remaining balance is long-term. Long-term liabilities are obligations not expected to be paid within the next year, like bonds or mortgage obligations. Separating them helps users see how much the company must pay soon, compared with obligations due later. Finally, we have stockholders' equity. For a corporation, this includes accounts such as common stock, retained earnings, and treasury stock. Stockholders' equity represents the owner's claim on assets after liabilities are deducted. A classified balance sheet provides this detail clearly. So why the effort? Classification makes the balance sheet much more useful for financial analysis. For example, analysts can compare current assets and liabilities. Analysts can compare current assets with current liabilities to evaluate if a company can meet its obligations. That relationship is the basis for measures such as working capital and the current ratio. Without classifications, these assessments are much harder. Let's review. A classified balance sheet organizes assets and liabilities into meaningful categories, like current assets, long-term investments, and PP&E. Assets are classified as current, long-term investments, PP&E, and intangible assets. Liabilities are generally classified as current or long-term. And the balance sheet also reports stockholders' equity for the corporation. The classified balance sheet organizes accounts into categories that make statements easier to analyze. I'm Dr. Jessica Woolworth. Thanks for watching. If this helped you, be sure to subscribe for more accounting lessons. I'll see you in the next video.